Hi, I'm Jim Mose, Executive Director of Faith and Finance Ministries at the Pension Boards of the United Church of Christ. In December of 2019, the SECURE Act was passed in Washington, D.C. It stands for Setting Every Community Up for Retirement Enhancement. The SECURE Act is designed to help individuals prepare for retirement. And with me today is Pension Board's partner, Dan Eck. Dan is the Managing Director of Ernst & Young Personal Finance. And Dan will highlight for us some of the features and objectives of the SECURE Act, and he will help us to see how it impacts clergy retirement planning and distribution planning. Dan, thanks for being with us. Welcome today.
Thanks, Jim. I appreciate you having me here.
Great that you can join us, Dan. Could you please start us off by sharing some of the key goals and features of the SECURE Act that our members need to be aware of?
Absolutely. Actually, the SECURE Act had two stated objectives in the Act. One was to increase Americans' ability to save for retirement, and the second was to improve their prospects for retirement in America. And to those ends, it simply added various levels of flexibility to retirement accounts, including distributions from those accounts in several ways.
And what are those changes in the SECURE Act that are likely to affect pension boards members in their retirement?
So the one change in the SECURE Act that probably has the broadest impact on retirement accounts is around something called required minimum distribution, or RMDs. Very simply, the SECURE Act changed the age related to RMDs from age 70 and a half to age 72. But let's explain that a little bit more and dig into that process. For anybody that is saved in a retirement account, like an IRA or a 403B as we have here, you've agreed to a couple of rules, whether you've realized it or not. And those rules dictate when you can and have to start taking money out of retirement accounts. So the first rule is what I'll call the too early rule, or the too early penalty. The IRS has said, look, these accounts are designed for retirement savings. So we don't want you to touch the money until you've retired. And they've defined retirement somewhat subjectively at age 59 and a half. So the rule says you can't access dollars in your retirement accounts until you're at least age 59 and a half years old or older. And then you're free to take money out as needed. Now, fortunately, there are some exceptions that allow you to get money out earlier than age 59 and a half, but that's the general rule. And to enforce that, there's a 10% penalty that says if you touch your money too early, you're charged a 10% penalty in addition to any taxes that might be due on those withdrawals. Now, on the flip side, there's also what I'll call a too late penalty. So you're allowed to start taking money out at age 59 and a half or older, but you don't have to. The IRS has said that's fine. You can let it in there and let it continue to grow tax advantaged even after age 59 and a half. But at a certain age, okay, we're tired of waiting as the IRS. We want you to start pulling money out of your retirement accounts. And if it's taxable, pay the tax that is due. Now that age, which is now called required minimum distributions, has always been age 70 and a half. And as we said, the SECURE Act very simply changed that age to age 72. And here's how it works. Once you reach that required minimum distribution age, you must start pulling out a minimum amount from your retirement account, pay tax on it if taxes are due, and you can leave the rest of the account in there to continue to grow. It doesn't matter if you've already pulled money out previously or you've let it grow without touching the dollars. Once you reach the RMD age, you must start pulling money out. And if you don't, the amount you should have withdrawn and didn't is subject to a 50% penalty. So you can see that too late penalty is quite significant and one that we want to pay attention to. So just to be very clear, the age used to be age 70 and a half, and that has not changed for anybody that turned 70 and a half before the year 2020. For everyone else, there's no required withdrawal until you reach age 72. And in fact, the rule used to be and still is that you can delay that first year's distribution until April 1st of the year after you reach age 72. So that's the biggest change and probably the most significant impact from the SECURE Act is on that required minimum distribution age from 70 and a half to 72. Jim?
Thank you, Dan. That's really important information. Now, is it true that there were also changes made by the Secure Act that aren't directly related to retirement?
There were, in fact, there were several we'll call miscellaneous income tax changes that were part of the Secure Act. Let me talk about one in particular that I think may be relevant. Now, most of us are familiar after years of doing our income tax returns, this concept of itemized deductions. Every year we have a choice to make. We can take a deduction that reduces our income, reduces our income tax, and that deduction can either be the standard amount that the IRS just gives us, or we can go to this form and add up all of our what are called itemized deductions, mortgage interest and charitable donations and things such as that, and see if they add up to a bigger number. And if they do, we get to take the bigger number instead of the standard amount. Well, one of those itemized deductions is around out-of-pocket medical expenses, and that's medical, vision, dental, the whole realm of healthcare or medical out-of-pocket expenses. Now, to be clear, that's not our medical or healthcare plan premiums. We pay those typically in a tax-advantaged way already, but we're talking about things we truly pay out of pocket, our deductible, our copay at the doctor's office, what we pay for our prescription drugs and things such as that. Those can be part of our itemized deduction, but there's a threshold we have to get over. Very simply, it's a percentage of our adjusted gross income, our income amount. If we have itemized deductions of medical expenses that are above that threshold, we can take them. But that percentage, that threshold has changed many times over the years. In fact, a 2017 Tax Act increased that threshold to 10% of our income. Well, the Secure Act very simply reduced that back down to 7.5%. So let's explain that with a real simple example. And I like easy math. So let's say our income on our tax return is $100,000. Well, 7.5% of that is $7,500. If we add up all of our out-of-pocket medical expenses, and they are more than $7,500, let's say they're $8,000, we can take that extra $500, the amount over the threshold, and make that part of our itemized deduction number. We can throw it into the mix, add it up with our charitable donations, and see if our itemized deduction number is bigger. So the change very simply reduces the threshold on out-of-pocket medical expenses as a deduction from 10% of income down to 7.5% of income, making that threshold a little bit smaller and easier to get over for some of us that have higher medical expenses that give us a tax advantage and a tax benefit for those expenses and costs. Back to you, Jim.
Dan, very much appreciate all this information on the Secure Act. Can you now also share with our listeners the benefit of EY services and the financial wellness benefits that are available at no cost to our pension board members?
Yeah, absolutely. Be happy to. Really thrilled that EY and PBCC have been partners in this program for many years. Our EY personal finance resources are available to actively contributing members of the annuity plan at no cost to you. And what this means very simply is comprehensive and objective financial planning for your own personal finance needs. So let me explain that. You have complete access to reach out to EY in a number of ways for any financial planning conversations or needs you'd like to discuss. And that may be a simple question or two. It may be a full comprehensive financial analysis, such as for retirement or asset allocation. You now have access to your own financial planners as needs arise and whatever those needs might be. And you have access in two ways. You can simply pick up the phone and call us, and you see the number, and talk to an EY financial planner directly. In fact, if you like that financial planner, you can continue to work with that same financial planner throughout the entire process and actually for years to come. You can also do this self-service. We have a financial planning website called EY Navigate that you can register on. It takes about 2 minutes to register. And you can do a lot of this planning completely on your own. You can run a retirement analysis or an education funding analysis, run some calculators, watch videos. And at any point, if you feel you've done all you can on the website on your own and you're ready for some live human interaction and help, you can connect directly with an EY financial planner right there on the website. Simply click on that button. You'll be connected with an EY planner during our business hours, or you can leave a message and you'll get a call back that next day And you can continue to interact with that planner either by phone or directly through the messaging service right there on the website. So it's here in whatever method you'd prefer to access the services and at whatever levels you might have a need. Again, very comprehensive planning or just a check-in every so often and a question or two here and there. Certainly encourage you to take full advantage of this no-cost service to you to use the EY Financial Planning Program. Jim?
Thanks, Dan. Really appreciate all of the need-to-know information you've shared with us today. Any closing thoughts before we wrap up our session?
Well, I do actually. No question, one of those next steps would be to call the EY Financial Planners or visit the EY Navigate website and start the planning. But I always end sessions like this with the same theme, which is do three things. Find three financial actions that have occurred to you as you listened in, or that I may have mentioned to you that are relevant, and do something financially to begin that momentum in that process after today's session. That may be to check your credit score or to call an EY financial planner or to pay a bill. Do something financially, start that momentum and continue that momentum and make sure that you do all you can to have a better personal financial future for you and for your family. Thanks, Jim, for having me. I appreciate the time.
Thanks, Dan. Appreciate your presence this afternoon and for bringing us up to speed on the Secure Act and how we can apply that information to our future financial planning goals. An additional piece of information I'd like to add is that at its recent meeting, the Pension Board's trustees amended our pension plan, the annuity plan for the United Church of Christ. The amendment allows for hardship withdrawals from our 403B plan in light of the COVID-19 pandemic. Members can withdraw up to 50% of employee contributions with a cap of $100,000. Now, the hardship must be related to the pandemic, and it can include loss of income due to reduced or eliminated positions. And the withdrawn funds may be repaid within 3 years. Please contact our Member Services Division for additional information.